Stagflation. You've heard the word thrown around everywhere lately. Here is what it actually means in one sentence. Prices go up and the economy slows down. So your money gets squeezed from both sides at once. Worse job opportunities and higher prices for goods. Now, here's what nobody's talking about. The people giving you advice today are using a playbook from a version of this problem that we will never see again. Because one number has changed everything. Here's the thing. Right now, a lot of financial advice you're going to see tells you to prepare for what's happening the same way people did in previous decades. The same old playbook, but that playbook was written for a completely different world. A world where the government didn't owe as much money. A world where the economy worked differently. What we're dealing with in 2026 has some familiar features, but the key details are different. And if you apply the wrong solution, you'll end up with the wrong answer. By the end of this video, you'll understand exactly what's going on and what that means for your money. Let me quickly explain what stagflation actually means because it's a word that sounds complicated, but it isn't. Normal times, prices are stable, economy is growing, people have jobs. Good. Recession, economy shrinks, people lose jobs, but prices usually fall too. Bad, but at least prices come down. Stagflation is the worst combination. Prices are going up at the same time the economy is slowing down. You're earning less and spending more. That's what we are dealing with. Here's where we are right now, in plain numbers. The US economy grew at just 0.7% in the last quarter of 2025. For context, healthy growth is usually around 2 to 3%. So the economy is basically crawling. Unemployment, the number of people out of work is at 4.4%. That sounds okay, but a broader measure that includes people who have given up looking for work or those who are working part-time but want full-time work, that is at 7.9%, nearly 1 in 12 Americans. And prices? Still rising faster than the central bank's target. Plus oil, which affects the cost of almost everything. It is sitting at around $100 a barrel due to the US-Iran war. It went above $100 for the first time since the Russia-Ukraine conflict in 2022. Slow economy along with rising prices. That is the simplest definition of stagflation. But here is what's different about 2026 and why the usual solutions are harder to apply. The classic way to fight rising prices is simple. Raise interest rates. Think of it like this. When interest rates go up, borrowing becomes more expensive. People buy less. Companies spend less. Demand falls. Prices eventually come down. Back in the early 1980s, the US Central Bank did exactly this, raised rates all the way up to 20%. It caused a painful recession, but it helped in reducing prices because the US government at that time did not owe much money. Here's the problem today. The US government has borrowed a lot of money over the past few decades. Right now, for every $100 the US economy produces in a year, the government owes $124 in debt. When interest rates go up, the cost of paying back that debt goes up too. Massively. Every time the central bank raises rates by even 1%, it costs the US government hundreds of billions more per year just to service the existing debt. So, the central bank is stuck. Raise rates too aggressively to fight rising prices, and you risk the government's finances spiraling out of control. Don't raise rates enough, and the prices keep rising. That's why they've kept rates around 3.5%, held steady at their last meeting in March 2026, instead of going much higher. And here's the really interesting consequence of this. Because the central bank can't be as aggressive as it once was, higher prices might last longer, which means the unusual market conditions we are in might also last longer. Let me be concrete. 3 things worth paying attention to. First, gold is sort of doing its job. Gold just crossed $5,000 for the first time ever. That is a record. People aren't just buying gold because of the uncertainty of what happens next. Gold tends to do well when people are scared, and right now there is a lot to be scared about. Second, energy companies are having a good moment. With oil above $100, companies that produce, transport, or refine oil are making more money. The energy sector is up nearly 10% this month alone, while most of the market is flat or down. The nuance here is that energy infrastructure companies, the ones that own the pipelines and shipping terminals, tend to be more stable than pure oil producers because they earn fees regardless of the exact oil price. Third, and this one might surprise you, some of the biggest tech companies in the world are actually reasonably priced right now. Meta, the company that owns Facebook, Instagram, and WhatsApp, it has a forward price to earnings ratio of around 21. What that means in plain terms, investors are paying $21 for every $1 the company is expected to earn next year. For a company growing earnings at over 20% a year, that is not expensive. Alphabet is at around 27. Amazon around 26. These are massive, profitable businesses that run largely on electricity and software, not oil and metal. When oil prices are high, a software company's costs don't go up as the same way a factories do. That's a genuine advantage in this environment. The short version, this is not the time to panic and sell everything. It's the time to think carefully about what you own. My honest view in this, what we are going through is uncomfortable, but it's not a catastrophe. Rising prices combined with a slow economy is a genuine challenge, but it's nowhere near as severe as similar periods in history. The key thing I keep coming back to is this. Right now, $8.27 trillion, that is trillions with a T, is sitting in US money market funds. Safe savings accounts earning about 4%, a record high. The moment the central bank starts cutting rates, a significant chunk of that money will move into stocks, bonds, and property. That is an enormous amount of fuel sitting on the sidelines. So my positioning is this: selective, not defensive. Energy and gold for protection, quality tech companies at fair prices for when the tide eventually turns. This is not the time to go all cash. It's the time to be thoughtful about what you own. The next video in this series is one I think is going to start a real debate. I'm going to show you both sides of the AI investing question. Is it a once in a generation opportunity or the most dangerous bubble we have ever seen? And then I will tell you exactly which side I'm on and where I'm putting my money. So subscribe if you don't want to miss it. See you next time.